Hi everyone, so Shopify, oh boy, here is a good summary of the situation.
My play is Shopify. Shares getting crushed today on news the Canadian e-commerce company will lay off approximately 10% of its global staff after making the wrong bet on how long the pandemic-fueled surge in online shopping would continue. The CEO, Toby Lutke, taking full accountability here, though, saying, quote, ultimately, placing this bet was my call. I got to make, and I got this wrong. You got to like the accountability there. Shopify, just the latest tech firm to announce plans to cut staff or pull back on hiring over inflation concerns, rising interest rates, and recession fears. Shares of Shopify, SHOP, now down 14% on this day and a staggering 77% year to date. Just another pandemic play getting hammered today, Rochelle.
I mean, it's interesting. Obviously, the pandemic was really a black swan event. So to see so much extra hiring during that period, it was really a matter of time before it was going to fall off. And people were starting businesses. They were loading up on Shopify. And they really thought this e-commerce boom limited to Shopify was really going to last. He said perhaps would change things for the next 5-10 years. But as people get more back into stores, they're starting to look at other brick and mortar businesses. Shopify losing some of its edge there. We see the same thing with Peloton. They were all gung-ho during the pandemic, thinking that some of these trends would continue for consumers on the other side of it. And we're seeing that that's not the case. So Shopify probably going to have to get a bit more creative at this point to really stay afloat.
Yeah, I think they will. And I think Wall Street's kind of searching for what the future will potentially look like for Shopify. We're seeing that reflected in their shares today. You talk about the fact that they might have to change their business here going forward to adapt to this quote unquote new normal after the surge that we did see in interest during the pandemic. So some of these pandemic winners are trying to figure out what business is going to look like post-pandemic. You can see it reflected Shopify today, 1 year, the stock off 80%.
Now, the reason why I'm here doing any of this is because I found that financial content online just felt a bit scammy, and I felt that if I show things like my entire stock portfolio, that this transparency makes me vulnerable to criticism, but very responsible for what I have to say. I'm not into crypto or NFTs or penny mining stocks. So here on my channel is my no bullshit approach to long-term investing and wealth. So Shopify has been getting crushed. And this now maybe is a reasonable time with all the blood on the streets to go take a look. Richard, my friend, hi Richard, who works in the e-commerce world said this, which I actually agree with. He said, look, the stock price is getting hammered at the moment. The long term, they are beasts. They've got great leaders. They're acquiring businesses like 3PLs and all the apps. They have ecosystem control. Once you're in it, you're kind of stuck or stuck-ish. But I've never looked at the financials. Now that's Richard's words. He sent that to me as a text. So for Richard and everyone else, let's take a look and see if we can figure out some sort of intrinsic value. So I'll check for revenue growth, their margins, their return metrics, their debt, their free cash flow, their share dilution, what insiders have been buying the stock, super investors, and then I'll do some sort of valuation. So let's start with the revenue. So total revenue in the second quarter grew at 16% year over year to $1.3 billion. Now, a metric they use is monthly recurring revenue, and as of June 30th, 2022, that was at $107 million. And that's a 13% year over year increase. So more merchants joined the platform, and the number of retail locations using their point of sale pro system, that increased as well. Then turning to their subscription solutions, well, that revenue was $366 million. That's 10% year over year. Then we look at gross merchandise volume. And for the second quarter, that was at $47 billion. That's across everyone's site on Shopify. And that represents a 3-year compound annual growth rate of actually 50%. And that's an 11% increase over from the second quarter 2021. Now, Shopify is trying to spin this positively by saying the 3-year compound annual growth rate of 50% compared to that far slower number of 11% for the past 12 months. But still, this is very solid revenue growth, even though it's obvious a slowdown is occurring. So gross margins historically have been around 55%, and that is going to come under some pressure now. So the gross profit dollars grew just 6%, reflecting primarily a greater mix of lower margin merchant solutions revenue, lower margins in their Shopify payments due to the merchant and card mixes, and increase investment in their cloud infrastructure. That's their words, not mine. Now, all up, I actually calculated that now the total gross margins isn't 55%, it's actually 50%. So that's down about 5%. And even if they did have this bad quarter, maybe a bad quarter or two coming up, which is what I think is going to happen, the business runs actually reasonably efficiently at this 50% margin. And if you are bullish on this company, there are a lot of add-on services that make incremental improvements to the margins as well that Shopify can pretty easily deliver in the future. Because they own the ecosystem and customers are sticky, that makes it a great business. Now, when I look at their return metrics, they're pretty ugly as the company doesn't make much profit, but there is about a $1 billion spend in their research and development that skews the numbers. I think R&D is investing in the future, so I'm sure a lot of that can be added back in. I'll go through this later in the valuation. Now, regarding debt, they're actually in a net cash position of $6 billion, so that's a very healthy balance sheet. They don't have any debt issues. Their free cash flow, look, I'm actually going to normalize this at about $1 billion per year. I'm going to assume a flat 2 years coming up while the business restructures all the staff that they don't need. Look, I think that's actually pretty generous. Now turning to share dilution. This is about to get worse before it gets better. See, Shopify has plenty of stock-based compensation. Like many Silicon Valley companies, this has gotten out of hand. Almost 9% dilution every year. And I hate seeing dilution at levels like this. Look, I can understand a tiny bit of dilution, but look, not at these levels. In my opinion, it's a sign management has this Silicon Valley short-term thinking methodology rather than a long-term investor thinking mindset. I just don't need that in my portfolio. Now, Tobias Lutke, the CEO, does still have a big stake in the business and is highly incentivized. He's almost 8 million shares at around $38 a share, which is worth about $300 million. Look, his net worth has gone from about $3 billion to a tenth of that. That is a dramatic swing, but I do like the incentives. It's good to see. Now, Stephen Mandel is a super investor with a reasonable stake in Shopify as well. That was once a really big portion of his portfolio. Now it's only a small portion. So about $1 billion in free cash flow is reasonable after adding back a big piece of that R&D spend. Look, I think it's very generous. I will show you why this isn't that big of a deal, that I'm not that accurate here. So I don't use my DCF here at the moment because I want to show you how the dilution rate really does affect this investment. So before we read too much further into this, I've got the current revenue number here, and I'm using a 5-year revenue growth rate of quite a reasonable 15%. What I've decided is that the next year or two is going to be single digits because that's sort of what's kind of happening in the industry a little bit. There's a fair bit of they're cutting a lot of jobs. They're trying to make it a bit more profitable again. I think if the revenue run rate can be sort of single digits for the next year or two, and then maybe it gets back up into the 20s and 30% range later in the 5-year period, I've called it about 15%, but it's not going to really matter here in a moment, which I'll show you. The estimated free cash flow margin, about 20%. That's really strong. I think they'll be doing well if they can keep anywhere near that. A free cash flow multiple of 25. That's pretty strong for a company growing at 15%. Look, I know multiples can get silly, but I don't care because that's not what I'm doing here. I'm trying to be conservative. I'm trying to be reasonable. 25 is still well above the market average. So just because they're a great business, I'm giving them 25 because of the sticky customers and things like that. The dilution rate of that 9%, shares outstanding, current market cap. What I've done here is I've just extrapolated out the revenue, the free cash flow, the target market cap in 5 years' time, and essentially a target price in 5 years is going to be $26, and it's about 30 something in the 35, something like that at the moment. So you'd be losing money on this investment, I think, based on these pretty standard numbers. Let me be a little bit more aggressive just to highlight how bad this dilution rate is going to affect this investment. So what I've done is I've just changed that revenue growth rate to 25% per annum for the next 5 years. That's significant. I would say that even with a rough year this year, them to get average 25%, which means they'd have to be probably growing at from years 2 to 5 at like 30+%, which they've shown they've been able to do. So let's play with it anyway. Keep that free cash flow margin because that's pretty close to accurate. We can maybe we can increase this multiple a little bit. And look, we're looking at 7%. Look, there's a lot of risk now embedded in this because I would say this is quite aggressive. And we're talking just a 7% annual return on your money here. This growth rate would have to get silly, like, let's call it 40%. And that free cash flow multiple. Now we're talking like pretty good numbers here, but look, things have to go just epically well for them to grow anywhere near. That's just not happening. I don't even want to put that number in because that's just such high upside that we just can't. We would be terrible investing. It would be a silly decision for us to assume those types of growth rates, especially based on them cutting 10% of their workforce, and they're in survival mode at the moment. They're trying to make sure they don't go bust, let alone growing at 40% per annum. So, there must be a less than 5% chance of that outcome happening. Therefore, I don't think it's worth even playing around with. This feels closer, something like this. I would really have to put that number down. And look, as you can see, this dilution rate is what's really hurting us here. If I turn that into 0, all of a sudden it's gone from, what was that before? It's gone from -1% to a reasonable average 7% compound annual growth rate, just because of that dilution rate. It really does handicap an investment when you have high dilution rates. You really don't want to see companies with that. I'm really trying to avoid them. A little tiny bit of dilution, I think I can get on board with as long as they're growing quickly. Like a little bit of dilution, like 1 or 2% max kind of thing. You don't want to see 9%. That means it's got to make, your return. You're getting a 9% handicap per year immediately. We don't need that type of. We don't need that handicap start. That's all. That's what I think. That's my opinion. All right. So here's the summary. Shopify is a really good business. Sticky customers, the ecosystem control that they have, and lots of expansion opportunities. But I think that even after being generous, everything has to go really right for this investment to be decent. Sure, maybe that multiple expansion gets crazy and goes to like 50 or something and stays there, but that's not what the intrinsic value would be in my eyes. I wouldn't chase a rebound here in the stock price. I think this is more likely somewhere around fair value. Now, if you like my buy prices, I actually keep them updated with the intrinsic values in my monthly e-magazine. I use Interactive Brokers to do my investing, which is the safest broker out there. Plus, don't forget about the Money Managers game that you can join and see whether you have what it takes to manage money. A lot of these things are in the description if you want to find out more. Now, if you hit that like button for me to see if anyone actually enjoyed this video, otherwise, I'll see you next week.